Welcome all. Now, in the process of learning about the cost of capital concept, I initiated this discussion in the previous class and it was just beginning at that time. So, now we will be proceeding further with the remaining discussion on this concept of the cost of capital. As I told you in the previous class, that is a very important concept, and everything means with regard to the overall evaluation of any project or any say investment proposal largely depends upon the cost of capital, and we use this cost of capital as a say a discount rate also for calculating the present value of the cash flows. So, since it is a very important requirement of the financial management as a whole, so we are learning about the cost of capital. So, in the previous discussion, in the introductory discussion or in the initial discussion, we discussed some just basic points of that what is the cost of capital, and then say how we calculate it, and the concept of the cost of capital which we use in the say the process is called as the WACC, weighted average cost of capital. So, we learned about the say beginning of or just initial discussion about the weighted average cost of capital. And now we will take up the further issues, and then we will learn about how to calculate the cost of the different say instruments of the capital or the different instruments of finance or different sources of finance, which is largely you can say two internal and external sources of finance. So, in case of the internal, we talk about the cost means the equity, not the cost, but the equity funds. Even the preference capital is also there, but for calculating the cost of capital, we treat the preference capital like the debt capital. So, we have the two kinds of the capitals, equity capital and preference capital, and then we have the external sources of finance, which is a debt capital, borrowed capital, right. So, for all these three different sources, two internal and one external, we will learn about how to calculate the cost of capital for these individual sources, and then how to arrive at the WACC, weighted average cost of capital, and there we will apply the concept of the flotation cost also. So, before we move forward into the different other important concepts of the cost of capital, I would like to discuss one important concept here, and that important concept here is the company cost of capital and the project cost of capital, right. So, we discuss here that for example, the firm is already into existence, they are already into the business and they are manufacturing different products, or they are say into the different business activities already. Now, they want to introduce a new product or maybe the new service or maybe the new business activity they want to add, maybe in the same line of the business or into the different line of the business, which you call it as the diversified say line of the business. So, that investment proposal or that investment opportunity will be treated as an independent project or a new project which is owned by or which is going to be say established by the existing firm. So, here we will learn about, or the question arises, which cost of capital will be important for considering it as a discount rate or the cost of capital, because it may be different that the cost of capital or the average cost of a capital for the existing firm is different, and the cost of the capital with regard to the sources of the funds which we are going to use for the new project, they are different. So, which cost of capital we will have to say talk about, and we will have to say, or sometime it may be possible that there is a mix of the sources of the funds, partly they are coming from the internal sources, partly they are coming from the external sources for the new project also, and the funds mix or the financial mix is largely same. So, which cost of capital we should be applying for the new project or the new investment proposal, whether the cost of capital of the new project or the cost of capital of the existing firm. So, here it is a very important clarification, I think we should be clear about that. So, when you talk about the company cost of capital, it is basically the rate of return expected by the existing shareholders. It is basically the rate of return expected by the existing shareholders or the capital providers. This is the company cost of capital. And when you talk about the project cost of capital, it is basically the rate of return expected by the capital providers for the new project, right, for this new proposal the company proposes to undertake. It will depend on business risk and the debt capacity of the new project, right, debt capacity of the new project. So, it means it may be a different situation, that the sources which we have been using for the existing firm or for the existing operations of the firm, they are different, and the sources which we are going to use for this project, because sometimes what happens that say when the new project or the new investment proposal is undertaken, it may be possible that say IPO or the FPO may not be possible, followed on say public issue or the public offer may not be possible, because people are not sure about the success of the new project. People are not sure about the success of the new venture. So, largely it may be possible that say for the new project or for the new venture, the capital is coming say largely as a investment from the existing firms, maybe from their reserves and surpluses or from their retained earnings, and partly we are going to borrow the funds from the market. Whereas in the case of the existing firm, the capital is coming or it has already come from IPO, initial public offer, by way of selling the equity shares in the market, and very lesser amount of the dividend we have very lesser amount of the debt we have say issued, or maybe raise the funds by way of the debt instruments from the market. So, this all depends upon that what are the sources of the funds for the existing firm and for the new project. If the sources of the funds are same for the say new firm, new project as well as for the existing firm, then it is always better advisable to use the existing company cost of capital as the cost of capital for the new project, right. So, we are writing here third point, the company cost of capital, which is the weighted average cost of capital, is the right discount rate for an investment which is a carbon copy of the existing firm, right. If now the two things must be two assumptions must be verified in case of the new proposal, that you can use the company cost of capital, existing cost of capital of the company as the cost of capital for the new project also, provided the sources of the funds are same as we are using for the existing operations of the firm or existing say processes of the firm. And second important requirement is risk profile or risk complexion of the new project is also as same as of that of the say the existing firm. So, it means if the risk profile is same and the capital structure is same, second requirement is the capital structure. So, this is the first requirement and this is the second requirement. If the risk profile is the same of the new project, if the new project is very risky, then I think we should use a different cost of capital or different discount rate for say discounting the cash flows, cash inflows especially, for arriving at the NPV of the new project. But if the risk profile is same as that of the existing operations of the firm and capital structure is also largely same, then in that case the existing cost of capital as a discount rate for discounting the cash flows for the new project can be used. So, we will have to be now careful in this case that what cost of capital or which weighted average cost of capital we have to use, and how to use that as a discount rate will largely depend upon from where the funds are coming and what is the risk profile of the proposal. For example, I talked to you about that fruit beer project of the Anchor Industries. So, in that case probably you cannot use the existing cost of capital because the product is totally new in the market and it carries as compared to the existing products of the firm the larger amount of risk. And so, if the risk involved is high, so in that case you can think about that the higher say discount rate can be used or the higher cost of capital can be used, because in that case means say risk profile is higher, and we always understand it that largely the rate of return say goes along with the risk associated with any investment proposal. So, risk and the return they have to coexist be the coexistent. So, depends upon what kind of the proposal is this, the new proposal is this, and how it is different from the existing operations of the firm. If it is same in terms of risk as well as the capital structure, then in that case I think the existing cost of capital can be used as a discount rate. But if the risk is high and the cost of if the risk is high and the capital structure is also different, and largely it happens that for the new projects the capital structure normally remains not as same as that of the existing firm. So, it depends upon that from where the say additional capital is coming, it is coming as a borrowing or it is coming as a say the investment by the existing firm. If it is coming up as a investment by the existing firms from the reserve and surpluses or from retained earnings, then fine, you can say the risk profile is low because largely the capital is from the internal sources, but risk profile has to be checked from the product profile product profiles angle also, the product which we are going to manufacture or the service which we are going to generate, and their say acceptability in the market, their say saleability in the market, all these factors have to be kept in mind. So, normally I would conclude this particular component that normally we should use the existing cost of capital, which is the existing say weighted average cost of capital of the firm if the risk and the capital structure profiles are same, but if the risk is more, then you can use the higher discount rate or the higher cost of capital, and if the capital structure is also different, then certainly it must be risky, then again we should use comparatively the higher cost of capital as a discount rate for the new project. Otherwise, the existing cost of capital or the weighted average cost of capital of the firm can be used. Now, we talk about, as I told you, that we will have to now learn about say calculating the cost of the different sources of the funds, because ultimately we are going to end up for say this concept or learning of this concept of the cost of capital, that is in the form of the weighted average cost of capital. And weighted average cost of capital will be possible to be calculated if you know the cost of capital of the individual sources of the capital. And I told you in the beginning of this lecture that normally the capital comes from three sources, two are internal, one is external. In the external also there can be multiple sources, but if you call it as one source as a whole, then it is called as the debt. External source of the funds is the debt, it can be the long term debt, it can be the short term debt, and in the internal sources it is largely the equity capital and partly it is the preference capital. But for calculating the cost of capital, for the purpose of calculating the cost of capital, we treat the preference capital also as same as the debt capital. So, process of calculating the cost of the preference capital is also same as the process of calculating the cost of borrowed capital or debt capital, whereas the process of calculating the equity capital is different, right. Calculating the cost of equity capital is more complex because there is a issue of the payment of dividend, right, and the dividend is always unstable. Dividend is always unstable. So, if we have the profits, but we require those profits within the firm for the reinvestment purpose, then we will not declare the dividend, right. So, the entire amount of the profit will be reinvested back into the business. So, what is the cost of equity in that case, right. Sometimes if we have the high profitability and we do not require the funds internally, the firms tend to pay the higher amount of dividend, whereas in case of the low profitability still the firms want to pay the dividend, dividend level comes down. So, means the cost of capital will be associated directly with the dividend being paid by the firm to the equity shareholders, and since that amount of the dividend is not pre-decided, it is not certain. So, the calculation of the cost of equity becomes a complex job, which is not the case in case of the borrowed capital. In case of the borrowed capital, the cost of capital is basically the interest cost at which we have borrowed the funds from the different sources, whether it is a short term source or it is a long term source. We know we are going to pay a fixed charge on that borrowed capital, and that fixed charge is basically the interest. And we are in all the situations, whether the firm is earning the profits or the firm is incurring losses, firm has to pay that cost of capital in all situations, in every circumstance, and say in the situation or in the event of profitability, the cost of debt will remain same. In the event of loss making situation, the cost of debt will remain the same. So, cost of debt is going to remain the same, it is stable, it is prefixed. So, it is largely easy to calculate the cost of the debt, whereas it is not the case in the equity. Similarly, for calculating the cost of the preference capital, when you calculate the cost of preference capital, that is also say associated to the dividend we are paying back, but see the dividend on the preference shares is largely pre-decided or prefixed. When the preference shares are issued in the market, what we write here? We write normally 12% preference shares at the rate of rupees 1000 per share. This may be right, this is the normal standard language, 12% preference shares at the rate of rupees 1000 per share. So, it means in this case this what it is written here is, that is the, what is this 12%? This rate is already decided. This is the rate of the dividend which will be paid or returned back on the preference shares. So, we write it like this, 12% preference shares at the rate of rupees 1000 per share. It means this is the 12% rate of dividend we are going to pay, and it is prefixed. And largely when in India we issue the, say, cumulative preference shares. Cumulative preference shares. So, what happens that in the 1 year, in the first year of the business, for example, if there is no profit available or sufficient profit is not there. So, this dividend cannot be paid by the company, or company want to postpone this dividend. So, in the next year, in the second year, dividend has to be paid at the double of the rate, 12% for the first year and 12% for the current year. So, it has to be paid at the rate of 24%. So, it will keep on accumulating, right. So, it means cumulative preference shares when we issue, largely we issue the cumulative preference shares, because if it is a non-cumulative preference shares, then in the event of non-profitability or say sufficient profitability, the preference shareholders will not get any return. So, to protect their interest, government insists for, regulatory agencies insist for, that the firms must issue the cumulative preference shares, so that the subscriber to the preference shareholders are entitled to the dividend in every circumstance, though the payment of dividend can be postponed from the year of the less profit or the loss to the year of sufficient profit or more profit. So, that means the firm is also running its operations, and the providers of the capital are also getting the good return. So, that keep on accumulating, and the cumulative dividend has to be paid in the year of the profit, and in that year the dividend for the previous years also has to be paid. So, since this rate is pre-decided, and in case of the debt capital, what happens? In case of debt, we normally borrow from the bank. For example, we are borrowing some amount of, say, 100 crores, we are borrowing from the financial institutions. So, what we are doing here, that rate of interest is already decided. For example, it is at the rate of 18% per annum. So, this 18% per annum is what? Basically, it is a cost of the debt, right, or we are going to borrow the, say, short term debt, or the short term borrowing we are going to have, and that is for the, say, 10 crores. So, it means that rate of interest is at the rate of how much? 12%. So, it means this cost of the capital is also known. In case of the long term debt, we are borrowing from the financial institutions, 18% is our interest. For the short term debt, we are borrowing from the banks, 12% is the interest, and for the preference capital, we are issuing the preference shares at 12%. It is prefixed, the percentage is prefixed with the share, that is a 12% preference shares at the rate of 1000 per share. It means in these all three sources, the cost of capital is very easy to determine, because already it is given. So, it is the rate of interest which we pay back to the source from where the funds are borrowed, and to the preference shareholders who subscribe to the preference shares of the company. So, it is very easy to calculate the cost of these three sources, but as far as the cost of equity is concerned, so it is very difficult, because I discussed with you the reason of volatility or uncertainty, because whatever the return we pay to the shareholders, that return is the dividend, right, and dividend is not certain. You all agree with me that dividend is not the right of the equity shareholders. It depends upon the state of the profitability of the company. If the company is earning the sufficient amount of the profits, then board of directors, is the right of the board of directors to decide whether to pay the dividend in any particular year or not. If the board of directors decide that sufficient profits are not there, or whatever the profits we are, say, earning, that needs to be reinvested back in the business also, so no dividend will be paid, right. So, and the flexibility in the hands of the equity shareholders is that if they are not satisfied with the performance of the company, or the dividend being paid or not being paid because of one or the other reasons. So, and if the company shares are listed in the stock market, are being traded in the stock market, then they are at the liberty of selling the shares in the market, in the secondary market, and getting rid of this investment. So, means both ways it is the flexibility to the company also, to the company management also, to company's boards also, as well as to the shareholders is is available, especially in case of the listed companies. But yes, the companies whose shares are not listed in the stock markets, and that does not happen. It happens only in case of the private limited companies. So, private limited companies management is basically very close knit, but in case of the public limited companies, the issue of dividend arises. So, their shares are being publicly traded in the market. So, if they are not satisfied with the policy of the company or the policy of the board of directors, they can get rid of this investment and they can sell it off in their shares in the market, because they are not getting the dividend. So, that depends upon what is our requirement, whether our requirement is the say regular income requirement or it is a long term investment requirement. If it is a regular income requirement, then you should look for that kind of the shares where the regular dividends are being paid. But if you are looking for the long term investment, then you are indifferent whether you are paid the dividend or you are not paid the dividend, because ultimately even if the dividend is not paid, it is going to be reinvested into the business, and that is going to increase the value of the firm or the overall equity of the or overall capital base of the company. So, ultimately the proportion of the shareholders wealth is going to increase, right. But there comes the problem for estimating the cost of equity, because of the say not certainty of the dividend to be paid by the company to its shareholders. So, there will be the say problem which we will discuss when we will reach at the equity capital. Now, we will start with the first capital, source of the capital, and here we call it as that the first source of the capital is the debt capital, right. And cost of the debt capital can be calculated very easily, very simply, because largely it is given to us, right. So, in this case, for example, this model is given to us. These are the components of the model, where you are given here as P0 is equal to sigma n, t is equal to 1, and then it is the I divided by 1 plus R d power t plus f, that is the f divided by the 1 plus R d power n. Now, what this model stands for? With the help of this model, you can easily calculate the cost of the debt. So, what are the components of this model? First is the P0. What is this P0? Current price of the debenture or the bond, right, at which that bond is selling in the market or that debenture is selling in the market, right. And I is the annual interest payment. This I is the annual interest payment, and that is for the number of years, that is the T, that for how many number of years this interest will be payable, that depends upon the duration of the loan or the duration of the bond or duration of the debenture. N is the number of years left for the maturity, that is the total, this is the current year, and then is the number of years for which that debenture is purchased or the loan is borrowed from the market, and F is the maturity value, this is the maturity value. So, means you get two components back, one you get the interest and second you get the maturity value. So, it all depends upon that if the interest is being paid by that say bond issuer or the company who has issued the bonds in the market or the say the debentures in the market, if they are paying the interest periodically, regularly, maybe 6 monthly or annually, then at the time of the maturity of the bond only the principal amount will be returned. And if they are reinvesting back, if you have opted for the option that I do not want the interest periodically, even my interest should be reinvested back, in that case in the maturity sum it will be returned with the principal amount and the interest on that. So, it means in this case, what is the case? We are now with the help of all these components, we are going to calculate the say the cost of the debt or the cost of the debt instrument. It can be bond, it can be debenture, it can be loan also, right. For the loan it is little different, but for the debenture and bonds we are talking here like this. So, you can say that your P0 is equal to, P0 is basically the current price of the debenture, and in this whole case, now for example, current price of the bond we are knowing, right, and the interest which is payable, that is also explained that every year this much interest will be paid by the bond issuer in the market and this much amount will be available as the maturity value. So, in this case we may not be able to find out what is this RD. RD is basically the interest available on this, basically you calling it as 1 plus RD, basically it is a discount rate you can say, which makes the your investment which you are going to make in the market is the P0, because ultimately in every investment instrument what happens that whatever the interest we get back and the maturity values we get back after the period of that bond or the loan or maybe that say debenture, that should be at least equal to the amount which we are investing today. And this is basically the process of calculating the NPV of the investment which we are making to subscribe the bond, and then we are getting the inflows back. So, inflows come in the form of interest and the maturity value, and we have to discount it at certain rate, and that discount rate is called as the interest available on that this debt instrument or on the bond or the debenture. So, this is RD is basically the bone of contention here which we have to calculate. If normally when we buy the bonds or debentures, we are given that we will be given this much of the annual interest and we will be given this much of the maturity value, but sometime they remain silent on telling what is the rate of return in terms of the percentage, and that is the basically the RD, that is the cost of the debt. And for calculating the cost of the debt, what you have to do is, now in this case because we are making this investment P0 in the market for buying one bond, and then this side, the right hand side will be available as the return in the form of interest and in the form of the maturity value. So, this P should be equal to the discounted value of I and F. So, it means both the sides should be equal, so that minimum your NPV is 0. You want that minimum your minimum requirement is NPV from this investment should be 0, so that whatever I am investing in the market over the number of years in the form of interest and maturity value, this amount comes back to me. So, this needs to be discounted. This interest inflow as well as the maturity value inflow needs to be discounted at certain rate, and that is written here as RD, and RD is basically the interest available or the expected rate of interest which is available from that investment or maybe the say subscription to that bond or debenture, that is basically a debt instrument. Now, RD is computed through the trial and error and all the times, because in case of the, for example, in case of the say you remember that is IRR, internal rate of return available from any capital investment proposal, there also we were using the trial and error, and here also we have to use the trial and error. We know the absolute values, we know how much annual interest I am going to get, we know that how much maturity value we are going to get for this investment into one bond or one debenture, but what is the rate of interest can be easily calculated, and for that you have to follow this approach which is called as the trial and error approach. So, it means that discount rate at which the discounted value of all the interest inflows and the maturity inflows becomes equal minimum to this, the purchase price of that debt instrument is called as the discount rate or the interest rate available from that investment opportunity or from that investment instrument. Now, sometimes what happens, this trial and error process becomes little complex. This process becomes little complex. So, we have the shortcut also. If you do not want to say follow this method of the trial and error, so what can you do is you can use this method which is called as the approximation method, right. This is called as the approximation method, where you can use this I plus F minus P0 divided by N, and then here in the denominator we use 60% of the purchase price which is P0 and 40% of the maturity value which is F. So, I is the interest, F is the maturity value, P0 is the purchase price of the debenture, N is the number of years for which that debenture is being purchased or the maturity period of that debenture is, and number of years left to maturity, 60% of the purchase price plus 40% of the maturity value. If you use this model, then directly without using the trial and error method, you can calculate this rate which is called as RD or the cost of the debt, which is called as the cost of debt, right. So, how it is to be applied? We have used a illustration here. Now, look at this illustration. For example, the face value of any bond or debenture is 1000. Coupon rate which is being said that this much of the interest will be paid, coupon rate is 12%, right. Maturity period is 4 years and current market price is the 1040, right. A bond which is having the face value of the 1000 rupees is being sold by the issuer in the market at the rate of 1040 means that bond is being sold at a premium in the market, coupon rate being promised is 12% and the say your maturity period is 4 years. So, it means when you use the approximation method, you can say that rate of return available from this investment proposal is how much? 10.7%. 10.7%. So, this rate of interest is 10.7%, coupon rate is 12%. So, it means what we are writing here is the approximate yield to maturity of this debenture is how much? That is 10.7%. So, it means in this case when you are saying the coupon rate is 12%, coupon rate is 12% means when you are reinvesting the interest back. So, total yield available from the total investment will be 12%, but if you want to talk about here the say yield or the interest rate available. So, interest rate is 10.7% which will become the coupon rate of 12%. So, we are using here simply means you call it as the coupon rate, we are saying 120 is the coupon rate, that is basically the interest available, and then we have this the say face value and maturity value. Sorry, this is the P0 is the face value, this is the maturity, this P0 is the current price, F is the face value, then is the 60% of the purchase price, market price, and then 40% of the say your face value. So, if you use this approximation method, you can say that discount rate of this cash inflow is 10.7% or the interest available from this project is or this particular bond instrument is the 10.7%. So, you should not get disguised by the 12% as a coupon rate. Actual return, actual rate of interest available from this investment proposal is 10.7%. This will become 12% when on the cumulative basis the interest being earned annually will be reinvested back, then it will become the 12%. But otherwise this is basically the rate of return available or the rate of interest available from this particular debt instrument is the 10.7%. So, this is the way we can calculate the cost of debt. Now, in case of the say bank loan, how to calculate the say cost of the bank loan, particularly in case of the banks, because we use the multiple sources, we use the bonds and debentures, we use the bank loans, we use the commercial paper also. So, different multiple instruments are used for say raising the debt from the market, both the long term debt and the short term debt from the market. So, in case of the debentures, we have seen that what is the model available, or if we do not want to use a trial and error method, we can use the approximation method. But in case of the bank loan, what interest or the what cost of that capital should be considered as the cost of capital. So, there in that case means bank loan means the current rate of interest will be the cost of capital. It may be possible that the firm has borrowed the say loan, existing firm who is going to start the new investment say process or the new project they are going to undertake, their existing borrowings rate of interest is 13%, but currently the interest to be asked or to be charged by the bank on the borrowing is 12%. So, it means the cost of capital for existing cost of capital on the bank borrowing to the firm is 13%, but on the new borrowing from the bank is 12%. So, for us the current rate of interest to be charged by the bank is important, and that we are going to consider as the cost of the bank borrowings, that we are going to consider the cost of the bank borrowings. Similarly, we have the other instruments like commercial paper and say other short term instruments. So, how to calculate the cost of commercial paper? When you talk about the cost of commercial paper is basically the short term debt instrument which is sold in the market. And in the commercial paper, how it is different from the normal debt instruments is that the normal debt instruments we make investment, and thus the avenue where we make the investment in those debt instruments, they pay the interest back to the investor, right. If we are subscribing to the bonds of any company, then we make that investment, and in return company gives us the interest on our investment, and at the end of the period of that bond or the life of the bond, they return the principal amount. But in case of the commercial paper, no interest is paid, rather commercial papers are sold at a discount and redeemed at par. they are sold at discount and redeemed at par. What does it mean? Now, for example, a commercial paper of 1000 rupees, right, will be sold at a discount of 10%. So, it means 10% of this will be 100. So, it means 1000 rupees maturity value commercial paper will be sold in the market for 900 rupees. So, you are investing 900 rupees for buying one commercial paper, and on the maturity you will get back 1000 rupees. So, it means we do not say pay the interest on the commercial paper, or the issuers never pay any interest on the commercial paper, rather they issue it at discount, redeem at par, and that difference between the purchase price and the maturity price is known as the interest or the return available on the commercial paper. So, it may be the commercial paper, or it may be the bank loan, or it may be the say short term borrowings. All these different sources have the different cost of capital, and how to calculate the cost of bond we have seen, how to calculate the cost of debenture we have seen. The bank, in case of the bank loan, the current interest rate to be charged by the bank will be the cost of capital, and in case of the instrument like commercial paper, which is largely used for the short term borrowing. In India, the commercial paper can be issued for minimum for the 7 days and maximum for the 1 year. Not for more than 1 year's maturity, the commercial paper can be sold in the market. And second thing is, the minimum investment requirement in the commercial paper is 500,000 rupees, 5 lakh rupees, and subsequent investment in the multiple of the 5 lakh rupees has to be there. So, I can say it is also not again a retail investment instrument. It is not for every individual, it is normally for the companies, banks, financial institutions. So, minimum maturity period is 1 week, maximum is 1 year, that is the commercial paper, and the minimum subscription or the investment is 5 lakh rupees, and subsequent investment in the multiple of the 5 lakh rupees. So, since the maximum maturity period is 1 year, so you can agree with me that it is a short term investment instrument for the investor, and it is a short term borrowing instrument for the borrower or for the company, and largely commercial paper is used as the source of funding the working capital requirements. So, different sources, different cost of capital, but finally on all the debt instruments, long term and short term, we can easily calculate the say average cost of debt or average cost of borrowings. So, how to calculate the average cost of debt or average cost of borrowing, that I will discuss with you in the next class. Thank you very much.